Mr. Gensler, you've done more than anyone in government to thwart the creation of an efficient ecosystem that will allow corrupt politicians to not have to have hundreds of thousands of dollars of cash and gold bars in their home when they could be discovered by the FBI. You prevented a system where we can have anonymous, unhosted wallets providing an efficient method for the corrupt politicians of the future. You are providing additional regulations which provide clarity to the market participants and protect investors, but according to a Bloomberg study, you're actually producing fewer regulations than your predecessor, recent predecessors. You're generally right, except swing pricing. And finally, ESG is material to investors. It will affect trillions of dollars of investment decisions. That's why corporate America is trying to prevent you from getting that information to the investors who want it. As the chairman points out, it's about capital formation. You're at the nerve center of the world capitalist system, where capital is deployed to operating businesses. If we have a shutdown of the government, I think it's already been pointed out by the ranking member that we stop all IPOs in their tracks. Does this also apply to companies that are already public but are issuing additional shares? And does it also apply to new bond issuances?
I'm glad to follow up and have staff chat with you. It's more nuanced. It really depends on whether they have filings that they can.
So a few of them are sophisticated.
Many would still, many public companies would be foreclosed from doing additional offerings. Others would be allowed. It really depends on the nature of their filings.
So a huge portion of our $100 trillion capital markets are not available to raise additional capital, or a huge portion of the initial capital that would be raised for operating businesses would be blocked. We also, as I understand, as far as providing assurance for the honesty of markets, you'll continue to collect emails as they come in, but you won't be doing any investigations or opening any additional investigatory files, correct?
It's really prescribed and narrow. It relates to a 19th century law called the Inefficiency Act, but we can protect public property. But it's
okay.
It's really
so nobody's going to be stealing your computers, but you're not going to be. It's going to be the Wild West on Wall Street, all while we're fighting for capital with other countries and other capital market systems. And we put up a sign that says, you know, closed. I can't think of a worse thing we could do to American capitalism. Swing pricing, I think it doesn't achieve its purpose. We should want people to invest in mutual funds and diversify and invest in America. But the swing pricing rule you've put forward has been criticized by a letter signed by the vast majority of Democrats on the Capital Markets Subcommittee, many Republicans, I think the vast majority there, the Consumer Federation of America. It seems to be an unfair rule in that giant players can participate in CITs rather than mutual funds, get the same benefits, not be subject to this rule. Investors will be told you may not get your net asset value. People who live in the Pacific time zone are disadvantaged. Any chance you'll be taking this rule back to the drawing board?
We've got a lot of comments. I'm very familiar with the letter that you and Representative Wagner co-authored. It's really going at a core feature that when you have a mutual fund, if you redeem in that mutual fund, you should redeem at the right price so that the remaining shareholders don't get dilution. It works well in normal times, less well in stress times, but we're taking all of these into consideration.
I understand. I'll simply point out that for many years, thousands of mutual funds, all competing for capital, could have adopted this rule, and not a single one of them thought, oh, this is what investors want. This is what will seem fair to investors. You've got the safeguarding rule. I'll simply comment that I think we need a safeguarding rule for intangible assets. Has that? I would hope that you would if you feel that tangible assets, such as real estate, need a safeguarding rule, that you would write a separate rule. Is the safeguarding rule that you're writing pretty much structured around intangible assets, such as crypto?
No, its genesis, it came from Congress itself. And as part of Dodd-Frank 12, 13 years ago, there was a new provision that the SEC address the custody of all customer assets by investment advisors. So it expanded it from just funds and securities to all assets. That was the genesis.
I would hope that the rule would have separate sections and a completely different approach for real estate on the one hand and crypto on the other. Real estate the title is public and the asset isn't moving anywhere, and intangible assets and crypto are very different. I believe my time has expired.